In Forex trading, a sniper entry is a type of entry that is characterized by its precision and timing. It is typically used by traders who are looking to enter the market at a very specific price level, where price will instantly go in their direction, thus resulting in no drawdown. In order to get a sniper entry, a trader needs to have a well-defined trading strategy and a good understanding of the market. One of the most important things to remember in Forex trading is that timing is everything. This is especially true when it comes to entries. In this video, I will explore with you how to get sniper entries when you're trading in the Forex market. We'll look at what makes a good entry, how to identify opportunities, and how to execute a sniper entry trade. This will be one of the best strategies that you can apply as a beginner. So without wasting any time, let's jump right onto the screen. So for this strategy, we are not going to be using any indicators. Instead, we are going to be trading from your S&D zones, which are your supply and demand areas. Now that means that we are going to be trading pure price action. If you are not aware of, you don't know what supply and demand areas are, then I suggest you subscribe to the channel so that when I drop future videos on supply and demand, you get notified. Step 1 of applying this strategy to get sniper entries: identify your overall market structure. Now, to identify your overall market structure means that you are identifying the direction in which price is heading into. The price can either be bullish or it can be bearish. Bearish meaning that it's on a downtrend, and bullish meaning that it's on an uptrend. If price is on a downtrend, then price is going to create lower lows and lower highs, meaning that it's going to be creating swings that are creating lower highs and lower lows, lower highs and lower lows. That will be continuing as price is moving. Now, if price is on an uptrend, price will create higher highs and higher lows. That is how you identify your market structure. If price is on an uptrend, it's going to be creating higher highs and higher lows. And if price is on a downtrend, it's going to be creating lower lows and lower highs. Step 2 of the strategy: define your trading range. Now, after you have determined whether you are on an uptrend or you are on a downtrend, you need to define your trading range. Now, your trading range refers to the difference between the high and low prices in a given trading period. For example, let's say you are on a 15-minute chart or you are on the 1-hour chart. It doesn't matter, but the time frame that you are on, you need to determine the trading range within the time frame that you are using to take your trades. So let's say, for example, you are on the M15 and you have an uptrend that is going on. To determine your trading range is quite simple. Remember, I just mentioned that the trading range is the difference between the high and the low of the price in a time frame. So now that you are on the M15 time frame, you need to determine the high and the low. So to determine your trading range, identify the recent low and the recent high. So you just go onto the chart and check on the trend. If it's an uptrend, then definitely it's gonna be creating swing highs and swing lows, right? So it will be creating higher highs and high lows. So you need to determine your recent higher high and your recent higher low. So for this trend that we have right now here, this will be your recent low and this will be your recent high. So this will be your trading range. So guys, it's quite simple to determine a trading range. You just pick out your recent low and your recent high, and you only pick your swings. So you cannot consider this as your recent high because there's no swing right here. Price is still moving up. Until it swings down, then this will be created as a new high. So for now, this is your new high and this is your new low. So that is how you create or you determine your trading range. For example, right here, this will be determined as your trading range. This will be your recent low and this will be your recent high. So this will be a trading range that you will be dealing with right at step 2. So step 2 is define your trading range, after you have determined whether you are on an uptrend or downtrend. Step 3 of applying the strategy. Now, after you have determined your trading range in step 2, you need to wait for break of structure. A break of structure happens when price breaks below the previous low in a downtrend, or when price breaks above the previous high in an uptrend. Now, this might be confusing, so let me give you an example. A break of structure in an uptrend happens when price moves above the recent high. So previously, when we determined our trading range, we established that this was our high and this was our low, and these were the recent highs and low. Now, whenever price moves and passes beyond the recent high, just like you are seeing right here, we experience what we call a break of structure. This happens on an uptrend. So we're on an uptrend. When price moves beyond the recent high, it is considered a break of structure. Now, in a downtrend, it happens when price moves below the recent low. So that is how you see a break of structure. So in step 3, you need to wait for a break of structure to take place. Once that is happened, you move on to step 4. Let's get right into it. Step 4 of applying the strategy. Now, before I move on to step 4, remember the previous steps. First step was identify your market structure, then define your trading range, then wait for a break of structure. Now in step 4, identify a POI. Now a POI stands for point of interest. That is considered as an area that price will likely react to in the form of supply and demand zones or institutional candles. Some people do order blocks. It depends on the type of trader you are. So for this strategy, we are going to be looking at supply and demand zones, your S&D zones. And I mentioned that if you don't know what your supply and demand areas are, then consider subscribing to the channel so that when I drop videos on S&D zones, then you can get notified and be learning about them. So to identify your POI is quite simple. In an uptrend, the last down candle before the up move will be your POI, and in a downtrend, the last up candle before the down move will be your POI. So let me give you guys an example. Let's say that we have a chart right here, right? The previous chart that I showed you. So we have a break of structure, we have a trading range, and we have established which market structure we are in. So now in step 4, you need to identify your POI. Now, I mentioned that in an uptrend, your POI will be the last down candle or the last red candle before the up move. So now if you can see, this will be the up move that made the break of structure. So the last red candle before the up move that made the break of structure will be considered as your POI. So that is the last down candle before the up move. Now in a downtrend, it's gonna be the last up candle or the last green candle before the down move. So the last green candle before the red candles or the down move that made break of structure. So that is how you identify your POI. It's quite simple and it works all the time for sniper entries. Step 5 of applying the strategy. Now, after you have identified your POI, you need to move on to the next step. Price mitigation. Now, mitigation might sound like a foreign language to a lot of you, but I'm gonna try and simplify it so that you can understand. Mitigation is the reduction of risk, and price will return to the S&D zone to reduce the risk. I'm not gonna go into further on how this happens or why it happens, but if you are interested in learning how, then you can join my Telegram where I share videos and more information about this kind of things. So mitigation means that price will return to your point of interest. Let's get into our entry criteria because we are waiting for price to come and tap onto our POI, and that is where our entry will be. Now for your entry, it's quite simple. Remember, you now have a break of structure and you have identified your POI. So we are waiting for price to come and tap into our POI as it is mitigating. So that is what mitigation is. Mitigation is when price comes to tap into our POI and move towards the upside and continue with the trend. So once you have your POI, for your entry, it's quite simple. On your POI candlestick, which is the red candlestick that created the up move, you are gonna take 50% of that, and that will be where your entry is. So your entry will be different depending on the type of trader you are, but I would recommend putting it at 50% of your candlestick. Now for your stop loss, you are gonna put the stop loss beneath the last candle that created the up move, where your swing was ending or where your swing low was created. Just beneath that candle, you are gonna put your stop loss maybe 2-3 pips below it, considering also your spread. And for your take profit, you are gonna put your take profit at the last swing high that was created. So that is how you define your trading entry, and this will usually create a sniper entry with a good RR. So after you've put your stop loss, your take profit, and your entry in the form of a limit order, then you need to wait for price to come and trigger your entry, then continue to hit your take profit. So price will usually come, then tap into your POI, and then continue to go in the direction that your entry is in. As you can see, your take profit was hit. So that is how you take a sniper entry when you're trading in the Forex market.